Hello, I'm Irina Oishkova, your nonprofit auditor. I have a small CPA practice in downtown Oakland and we serve nonprofit organizations for many years. NAP stands for Nonprofit Auditor Points, and I design NAPs to guide and help nonprofit organizations on some accounting and finance issues. Before we start, it's a disclaimer that these videos are not designed to be authoritative guidance. If your nonprofit have any specific issue pertaining to your organization, you need to consult your own CPA and your finance and accounting team. All my videos are based on GAAP, General Accepted Accounting Principles, and GAAP using accrual method of accounting. And today's NAP, we're going to continue analysis of financial statements. In the previous NAP, we described 4 main financial statements that nonprofits have to present in order to have a full understanding of financial position of the organization. To remind you, these 4 financial statements are statement of financial position or balance sheet, statement of activities or profit and loss statement, statement of functional expenses, and statement of cash flow. And today we're going to analyze and look at the statement of financial position or balance sheet. In for-profit companies, the statement called balance sheet. In non-profit, statement of financial position. This statement typically is presented as a first statement on financial package. And the statement is very critical for analyzing financial position of the organization at that specific period of time. Balance sheet or statement of financial position, it's a snapshot of the organization position at that period of time, specific point of time. For example, if your organization year end is December 31st, that position will be presented on the balance sheet as of December 31st. January 1st next year, position might be already be different. And statement of financial position or balance sheet consists of 2 main parts. Assets, meaning everything that the organization has, and liabilities and net assets. This everything that the organization, liabilities, everything that the organization owes to third parties, and net assets is similar to equity for profit world. It's called balance sheet because these 2 parts have to balance. They always have to agree. Totals have to be the same. So let's take a look at the first part, which is asset. Assets typically split in 2 parts, current assets and non-current assets. Current assets, typically the assets that can be converted to cash within 12 months, meaning that they're very liquid assets. And those assets are typically cash, investments, prepaids, could be inventory. Even some of the current assets, even though they're current, they might not be liquid enough. For example, inventory might not be a liquid asset. Prepaid might also be not a liquid asset because typically if the organization prepaid for some expense, it's very hard to get money. It's not guaranteed that you will get the money back within 12 months. So typically liquid assets will include cash, investments, and receivables, accounts receivables, right? Or pledges receivables if they current. So all these current assets are presented in order of liquidity as a current on the top of the balance sheet. And then we have non-current assets. Those are assets typically non-current investments, maybe long-term investments, if the management invests in something that is not intended to use within the next 12 months. Very common long-term assets, it's plant, property, and equipment, such as fixed assets, tables, chairs, buildings, land. Those are fixed assets, non-liquid. Could be long-term pledges receivable, non-liquid, meaning that those pledges will be collected in a period after the 12 months, those are non-current assets. Why it is critical to split net assets in the current, non-current? Because it also shows availability of future cash and liquidity position of the organization. Again, all these assets indicates everything that organization has. One comment here, typically current assets such as investments, cash, prepaids, they typically presented on the it's a cost basis, but it's basically very similar to fair market value. So if your cash is $10,000, it's a fair market value, but it's also cost basis of the cash, right? For non-current assets, especially such as plant, property, and equipment, they're stated at cost. We don't market to market fixed assets. Fixed assets stated at cost, less accumulated depreciation. So they are stated at net value. Therefore, they're not always representative of liquidation value of this asset. So it's stated at cost. Again, these are assets. Now, if the second part we look, liability. Liability is everything that organization owes to outside parties. And they also can be current and non-current. Typical current liability is all our accounts payable, accrued expenses, such as accrued payroll that organization owes to employees but was not paid before the year end, some accrued benefits, and could be also long-term liability. And long-term liability can include like a long-term debt, not payable. And again, liability is very important to present in liquid position. In readers of financial statements, when looking at balance sheet, they always want to compare liquid assets with the liquid liabilities to ensure that the organization has at least same amount of liquid assets as the liquid liability. It means that the organization has sufficient amount of liquid assets to pay its current liability. So therefore, liquidity ratio is very critical. It needs to be at least one meaning you take liquid assets divided by current liability. And if it's 1, it should be at least 1. Preferably, it should be 1.5. So the organization should have more liquid assets to cover its current liability. And that's one of the main criteria that readers of financial statements use to analyze balance sheet. They do look at liquidity of the organization. Organization cannot be highly leveraged and cannot have very little assets that will not be able to pay its current liability. And the second part of the liability section it's a net asset. Net assets or equity. Very similar to equity in nonprofit world. In nonprofit world, we call equity because it's investors or owners' contribution to the company. Because nonprofit organizations don't have investors and owners, these net assets, it's everything that organization accumulated from inception up until that moment of time. So it's everything like a cushion, that assets that organization accumulated that can be used in future operations. And that section is split typically in 2 main sections, not assets. Then can be net assets without donor restrictions and net assets with donor restrictions. Preferably, we would like to see more net assets without donor restrictions. What it means that organization can spend these accumulated funds for any purposes within the organization mission, for anything, for program, for management in general, for fundraising, whatever the organization need. If the funds are with donor restrictions, then the organization is limited to spend these funds only with the wishes and restrictions that donor put on these net assets. net assets with donor restrictions can be temporarily in nature or permanently restricted. Permanently restricted, another word for them is endowment. It means that the organization cannot spend this money at all. The organization holds them and can only spend interest, dividends, investment return typically. But the corpus cannot be touched. But temporarily restricted by donor restricted assets can be spent, but they can be spent only in a frame that donor restricted, and donor can restrict them either by purpose or by time. So the donor can say you can spend this money over X period of years or for this specific purpose, and the organization have to follow that restriction. And that another section where the readers of financial statements look in the net assets section. We want to see preferably more net assets without the donor restrictions. And also we want to see ideally that organization accumulated enough net assets to sustain its future operations for at least 3 to 6 months without any additional support. It's called like a cushion, like a reserve. Ideally, it would be great if the organization accumulated up to 12 months. It provides great sustainability for the organization to know that it has sufficient amount of assets accumulated that it can sustain at least 12 months, a year of operations without any additional dollar support. Net analysis of net assets section is very critical. Therefore, highly recommend nonprofit organizations make sure to track net assets section by splitting what is the net assets with donor restrictions and without the donor restrictions to understand what the organization ability to spend funds, and try not to commingle restricted and unrestricted, because that this is non-compliance. An organization have to follow the restriction requirement given by donors. In very rare circumstances, organization might have a lot of net assets with donor restrictions, but very little net assets with no donor restrictions, without donor restrictions. And it's very tempting for nonprofits start using assets with donor restrictions for not intended purposes. That would not be compliance. Nonprofits not allowed to do that. Therefore, it is possible that organization might have available funds, but does not have funds to spend for whatever need it has, because it's restricted for the specific purpose by the donor. To summarize, statement of financial position or balance sheet is very critical statement that very often is not analyzed enough in its monthly, quarterly packages by the board and by the management. I highly recommend for nonprofits to develop system of controls and procedures to run these statements and look at the balance sheet at least on a quarterly basis to understand what the organization liquidity and what the organization is split of net assets between restricted and unrestricted. Thank you so much. In the next snap, we will be discussing statement of activities or profit and loss statement. Thank you and have a good day. Appreciate you being here with me. Talk to you soon.